We've recently talked to lots of businesses and professional advisors like solicitors and accountants, and what we've come to realise is that many business owners do not understand or are not aware of the products that are available to help their business should a shareholder or partner die or become critically ill. Unfortunately, from our findings, most people are not aware of the protection products that are there to support and help your business plan in the event of illness or death. What I'm going to talk to you about is how you can protect your shareholding or partnership in the event that somebody within the business dies or suffers from a serious illness. First of all, what is shareholder protection? Shareholder or partnership protection is simply life insurance or critical illness cover that the shareholders or partners of a business arrange in order to give them the money to be able to buy the shares off of a deceased shareholder's or partner's estate. Critical illness cover can be added to this at an additional cost, so that the business has enough money to buy the shareholder or partner's shares should they wish to sell through ill health. And why would you need shareholder or partnership protection? Let's give a real example of how shareholder or partnership protection works. Mr. Smith and Mrs. Jones own a bakery and over the years have built up a very successful business. Mr. Smith is a 60% shareholder and Mrs. Jones owns the other 40%. Unfortunately, disaster strikes after Mr. Smith is diagnosed with a serious illness and passes away within a short period of time. Mr. Smith's estate have now inherited his shares, however they have no interest or business acumen to want to take over his responsibilities, and nor does Mrs. Jones wish for them to. So, in order for Mrs. Jones to be able to be the sole owner of the business and retain control, she needs £600,000 to pay the estate for Mr. Smith's value of the business. Taking out shareholder protection, she has received a lump sum on his death of £600,000, which she has paid to the family, and she is now 100% owner of the bakery. Mrs. Jones is delighted to have been able to have retained control of the business, and Mr. Smith's family are also happy that they've received a fair value for Mr. Smith's hard work within the business. Now we're going to look at what the benefits are to a business when taking out shareholder or partnership protection. The benefit of having the money to buy the shares is that the remaining shareholders or partners can keep control of the business moving forward. Because the existing shareholders and partners have the money to be able to buy the shares from the estate, they do not have to then have them sold on the open market, where somebody could come in and run the company who does not have the necessary skills or experience. By having the shareholder protection in place, the existing shareholders or partners don't have to worry about having to borrow the money in order to purchase the shares from the estate. Borrowing the money could prove costly, affect future profits, and may not be easy considering that one of the main individuals within the business is no longer there to drive it forward. In the event of sickness of one of the owners or shareholders, they can then sell their shares back to the business and again receive a fair value. When shareholder protection is implemented, there are trust documents drawn up which clearly state what will happen to the money if the policies are claimed upon. The benefits of that are that if the estate want to sell the shares, then the business have to buy them, and likewise, if the business want to buy the shares, the estate has to sell them.